Today we're diving into one of the most volatile and frankly confusing events in the silver market in a long time, the extreme price action during early January 2026. And it's all centered around the mandatory rebalancing of the Bloomberg Commodity Index, or BCOM.
That's right. And the core tension here is critical. On one hand, you have this almost hysterical narrative that a forced sale of potentially $7 billion worth of silver futures was an unavoidable market meltdown.
Exactly. And on the other, there's the view that, that this was all just a scheduled, predictable event that was ruthlessly exploited by institutional short sellers. So the question we're asking is, was this rebalancing a genuine crisis, or was the crisis narrative itself a calculated manipulation? I'm going to argue that the meltdown story is a hoax, designed to cover massive, underwater short positions.
And I'll be coming at it from a different name. While the language of the narrative was, I agree, hyperbolic, I argue that the sheer quantifiable magnitude of the selling created a real tactical market risk that justified significant caution. The index flow was a genuine destabilizing factor regardless of the spin.
All right, so my core position really hinges on the irony of the mechanics here. The $6 to $7 billion BCI outflow was mandated, yes, but it was a telegraphed punch. I mean, we knew about this since the new target weights were published back in October 2025. And crucially, this wasn't selling because of some fundamental weakness. This was selling because silver had performed too well.
That's the context missing from the meltdown story. Silver soared, about 150% through 2025. So its success ballooned its weight in the BCOM portfolio from its target of around 4.5% to nearly 9 or 10%. The robot, the algorithm, was forced to sell simply to trim it back down. The index mechanics effectively punish success. This is a technical, bureaucratic sale, not a fundamental one.
Okay.
So the evidence for the hoax lies in the coordinated, aggressive language we saw from brokers. Terms like guaranteed crash, structural liquidity event, while they were recommending short positions to retail clients. That panic-inducing behavior is designed to exploit the non-expert, force them to sell their winning positions, and thereby provide the liquidity institutions desperately needed to exit their own staggering short positions. The volume of selling is real, but the timing and the interpretation of it, that's the lie. Sophisticated players had already absorbed this months ago.
I'm sorry, I just don't buy that the entire phenomena was just a deception aimed at retail. I mean, while I acknowledge the irony that success drove the sale, we can't just dismiss the quantitative impact. This scale is undeniable, and it represents a substantial, justifiable short-term risk.
But the scale was known.
The scale was known, but let's look at the numbers. The index had to dump approximately 5% of its entire $108 billion portfolio. That translates to somewhere between 5.4 and maybe $7.7 billion of silver futures. That's 70 to 100 million ounces hitting the market over just a few trading days. That is roughly 10% of annual global mine production suddenly dumped on the paper market. You can't tell me that isn't disruptive. And the evidence of the impact is clear. The selling was not fully absorbed ahead of time. Silver prices peaked above $80 in early January, but they pulled back sharply before the core index sales even happened, declining about 12% in total. That correction was real. It confirms that the index-driven flows created genuine short-term price pressure. And it wasn't a secret conspiracy. You had Citigroup, Deutsche Bank publicly issuing warnings about this. TD Securities publicly announced a massive short position at $78. That level of institutional conviction shows the perceived risk was genuine.
Okay, but I'm not convinced that a 12% drop proves the crisis was real. I think we have to distinguish between the full $6 or $7 billion mandate and what was actually left for that official rebalance period.
Okay.
Look, the smart money, the active managers who track BCOM but aren't legally bound to wait, they spent November and December methodically offloading their exposure. They were front-running. They were selling quietly into the rally's strength. So by the time January 8th arrived, only the rigid passive index funds were left to sell.
The ETFs, right?
Exactly. The ETFs and funds legally prohibited from trading early. They represent maybe $2 to $3 billion remaining of the total mandate. This final flow is, frankly, it's the tail of the dog, not the main pressure wave. The fact that the initial drop happened in late December proves the active market had already eaten the meal. The brokers are now pointing to the indigestion from the last couple billion and calling it a crash.
That's a compelling argument about the front running, but calling $2 to $3 billion insignificant is problematic. Have you considered that the 8 to 12% slide suggests the paper market structure, the COMEX, was so fragile that the remaining passive sales still caused a significant dislocation?
I'd call it a consolidation, not a dislocation.
Well, let's challenge the terminology. After a 150% gain, is an 8 to 12% drop really a meltdown? Of course not, the term is exaggerated. But the price drop proves that liquidity was constrained enough to force prices lower. Even sophisticated players flagged the first half of January as a serious technical risk, purely because of the sheer volume. Knowledge of a flow doesn't mean the flow is harmless. It just tells tactical traders when to short. The air pocket was real, whether it was caused by 6 billion or the final 3.
So let's turn to the human element then, the cui bono question. Who benefits? While it's a sound question, a bank's motivation can be dual. Self-interest, sure, but also providing legitimate risk advice, even if it's framed very aggressively. The fact is, banks were bleeding futures contracts during that 2025 rally. Lease rates for physical silver spiked to 200% overnight at one point. That's a clear sign of panic and physical shortage. There were reports JP Morgan had to lease 4,000 tons of silver from a Chinese bank just to cover shortages.
I remember that, yeah.
So they were under enormous, verifiable strain from these record-high prices. Any opportunity, like the BCI rebalance, to frame the market bearishly for even a short time eases that strain. The warnings, even if exaggerated, were a reflection of genuine institutional positioning and the massive pressure they were under. This wasn't just a story they invented for fun.
I see that point, focusing on their pain and their need for relief. But let me offer a different perspective. If banks are net short, their warnings are inherently self-serving. And the language we saw, guaranteed crash, wake up poor, that goes far beyond prudent risk management. It's strategic narrative control.
You're calling it a psyop.
It is a psychological operation, a psyop, aimed at inducing retail panic selling to provide the liquidity they desperately need to cover their shorts. They are desperate for someone to sell to them, and the only way to manufacture sellers in a strong bull market is to scare the retail investor into being the victim. They know the price is moving higher long-term, and their only hope is to manufacture a deep, temporary paper dip using the BCOM excuse. They need those contracts.
Sure, but
Because if they don't buy from panicking retail sellers, they have to buy from the physical markets, which leads us directly to the China shield. The fundamental reality that destroys this whole meltdown thesis is the China shield. The arbitrage between New York and Shanghai right now means silver is trading at a record premium, $7 to $8 an ounce over the COMEX price.
a huge premium.
It's a massive global floor price set by industrial demand in Asia. Every single ounce the BCI algorithm spits out in New York is instantly swallowed by Eastern buyers who convert that cheap paper contract into physical metal. China controls 80% of global solar panel manufacturing. They aren't trading for bonuses, they're trading for industrial survival. They look at a forced technical sale in New York not as a panic event, but as a clearance sale.
That's an interesting point, though I would frame it a little differently. The Shanghai premium is a massive, powerful, long-term support, I agree. It's an undeniable price floor for physical metal, but it doesn't instantly negate the short-term impact on the paper market, which is where the BCOM rebalance happens.
But it absorbs the selling.
It absorbs it eventually, but a forced $6 or $7 billion flow can and did temporarily suppress the COMEX paper price. That 12% drop proves it. It just had the side effect of widening that premium to $7 or $8. So it confirms the event created a huge buying opportunity for Asia, yes, but it doesn't negate the fact that the sellers, the index funds, were still forced to take a loss relative to the price high they saw days earlier. They sold around $75. The paper market experienced a crisis of liquidity, which is precisely what the institutions warned about, even if their motives were self-serving.
So look, I think this debate confirms the $6 to $7 billion sell-off was real and mandated by bureaucratic index rules. But we've also established that the smart money had already managed their exit. The narrative that was pushed aggressively by strange short sellers that this was an unforeseen meltdown was a clear distortion designed to manipulate liquidity. The massive physical demand from Asia, shown by that record premium, stands ready to absorb any temporary paper dip. The best strategy was to hold the line, not provide bailout liquidity to short sellers.
And I'm still not convinced the warnings were purely a hoax. I think they were a hyper-aggressive, self-serving warning about a massive, telegraphed flow that did in fact cause a measurable 8 to 12% short-term correction, validating the tactical risk. The fact that the price is stabilized and is expected to rebound confirms the fundamentals are overwhelmingly bullish and the selling was purely technical. Yet, I think investors have to acknowledge that events of this scale create genuine tactical vulnerabilities in the paper market. And what this really shows is how sophisticated players use predictable events to desperately try and cover their own massive positions, even when the long-term fundamentals are pointing in the complete opposite direction. There's clearly more to explore.